Years I've been saying that silver is destined for triple digits, and I have been called crazy because of that, but I stand behind that. I'm going to compare silver and see what the price would have to be if you adjusted it to keep up with if it went into the same type of bubble that it was in back in 1980 compared to other portions of the economy. I'm going to inflation adjust it. I'm going to compare it to real estate, to stocks, to bonds, and to a bunch of different aggregates of the currency supply. And we're going to see just what silver's price would have to be to strike that same balance that it had when it was in a hyper bubble back in 1980. In the 70s, it went through this amazing bull market, and it was punctuated by a correction in the bull market. In January of 1980, when gold and silver went into their hyper bubbles, their super spike, that was not a full-blown currency crisis, a monetary crisis. What that was geopolitical tensions with the Iran and with the oil embargo and with big inflation. Those are the things that people were worried about. They weren't worried about U.S. treasuries or the dollar. They weren't worried about the potential collapse of a monetary system or a big shift in the monetary system. The next time that gold and silver go into their hyper bubble, their super spikes, it's going to be during some sort of crisis that is basically just the backlash from all of the monetary madness that you've seen over the past several years. I'm absolutely convinced that this will play out, and I personally have pretty much bet everything on it. And here I've got $50 in January of 1980 equals $175 today. But I call this the CP lie, not the CPI, because in 1980, along with this date that we're working from, that's when they stopped measuring the same set of goods and services and what the actual price was throughout the decades that they had been following for many, many decades. And they started doing things like substitution and hedonic adjustment. Substitution, they decided one time that sirloin steak was too expensive, so people would eat chicken instead. That was under Greenspan. What I'm interested in is the real price of things. If you read his public comment on inflation measurement and the changed CPI, you look at the methodology that he's using. He's using the government's own numbers against them. So he's using CPI-U-RS versus CPI-U series, and then calculating some of these things. It's very interesting. Now, I believe that the truth lies somewhere in the middle, that the numbers that he comes up with here are exaggerated. If you use $50 in January 1980 through to today, you've got the Bureau of Labor Statistics calculation of $175 per ounce of silver. This is the median sales price of houses sold in the United States. So this is the Federal Reserve's data, and we're going from 1980 here. And the growth factor on houses, it's up 5.5 times, which would give you an adjusted, if silver had kept up, if it was in the same balance today as it was back in 1980 against real estate, it would have to be $275 per ounce. So let's take a look at the S&P, the Dow, and the Wilshire. I'm going to sort of average. If you take all three of those, you come out with growth ranges of 38 times to 40 times from January 1980 to today. And so that ends up with an adjusted silver price, if it was in the same balance as it was back then with the stock market. Now, you got to realize by 1980, the stock market had gone sideways for more than a decade, 1966 to 1980. So 14 years of just moving sideways. The stock market had become very undervalued. And that's when silver went into its hyperbump. And so if it went into that same balance today, we've got the stock market severely overvalued, but the growth in the stock market is 38 to 40 times. So you've got $1,900 to $2,000 per ounce of silver. Now, that is way off to the crazy end. I'm not saying it's going to quadruple digits, but anything is possible. I think some of this stuff is hilarious, and it's fun just to take a look at. Let's look at bonds. Now, bonds on stock charts, I can only find the 10-year bond price going back to 2000. They don't quote the price on the Fed's website, but this is a bull market here. It's just that the yield on the bonds is sort of the inverse of the bond price. And so even though this is going down, this represents a bull market.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel.
If you go from January of 1980, or if you take the beginning of the bond bull market in 81, September of 81, if you go January of 1980, bonds are up a factor of 7.2 times. If you use this 81, when the bull market in bonds really began, then you've got 10.2 for an inflation-adjusted silver price of $360 to $510 per ounce. The monetary base, I decided not to use this. Why? Because the monetary base, most of it is reserves of depository institutions. So the reserves that the banks have, this portion of the monetary base never leaves the Federal Reserve. This is in the accounts that all of the banks have at the Federal Reserve, and all of the banks have to borrow from each other at the end of every day because basically banks are broke. So they have these reserves. You know, what's interesting here, these reserves were fine at $30 million, $15 million, $40 million, $40 million. And then suddenly $3.8 trillion isn't enough, and we have to keep on. So just shows you the crisis of 2008 never ended. They only papered over it. When we finally get to the end of this and the paper starts coming off, when the wallpaper starts peeling and you actually see what has happened to the banking industry and the real economy, it's going to be a bloodbath. Gold and silver will be the big beneficiaries. And so we could probably see some of these balances change to where it's an even bigger hyper bubble against these other asset classes. And if you use M2, and M2 has grown 13.74 times, giving you an adjusted silver price, if it was in the same balance against the M2 currency supply, of $687 per ounce. So let's go to MZM, which is actually the broadest measure. It's bigger than M2. You know, they discontinued M3 years ago, so it's actually bigger than this growth factor. It's a growth factor of 25 times, giving you a silver price of $1,250 per ounce if silver was in the same balance as this aggregate of the currency supply. Now, remember, gold and silver are money, not just currency, but money. These are the deflators, the CPI, the alternate CPI, real estate, stocks, bonds, GDP, currency in circulation, M2, MZM, and money market funds. And the average there, I excluded these because of some of the things that they had done to them when it came to the average. I should have left in currency in circulation and M2 and just excluded money market funds. But it's a growth factor of 15 times when you take all of these and average them for a per ounce price of $750. Now, when I had included all of these, it was a growth factor of 22 times for a price of $1,100 per ounce. Now, I have never claimed that silver is going into the quadruple digits, but you know what? Anything is possible. And I absolutely stand behind my claim that silver is going to triple digits one day. It absolutely will. This is my belief. I stand behind it. There isn't anything that I can measure that would show it not going there.